Hello, welcome to Financial Detox. I'm Jason Labrum, your host in studio with
Alex Klingensmith.
And we are here, Financial Detox, bringing you one of our last shows of the year, Alex. This could be one of the last shows of the year. I mean, I think the title even says end of year. What should I be doing, right? Something like that.
That's exactly right, Jason.
What does it say, Alex? Tell us what this show is going to be about as we help people get financially detoxified, manage their wealth for maximum impact. And this is how we do it right here. So we're going to get after it.
At the end of every year, going into the next year, I think it's a really common question we get asked is it still safe to be invested? Next year, the unknown's coming. There could be changes in politics. There could be changes in the world around us. We just don't know. So is it a good time to move to cash? Is it a good time to make changes in my portfolio? These are the questions we're going to answer right now.
We're going to hit it. And it's a great question. And we know that you are asking this question because we asked ChatGPT what questions are our perfect clients asking. So we know it's true, right? Because it's
a good question.
It is a good question. And look, this plagues investors, and it has for 100 years, right? Behavioral blunders tend to be the largest detractor of returns from portfolios. They don't tend to be, they are. So if we can help you get financially detoxified, avoid behavioral blunders, we can almost be certain that you're going to have better returns than the huge preponderance of all investors out there. That's a Nick Murray quote. But you're going to have those because you're not going to make the behavioral mistakes that most investors make. And that's what we help people do so that they can enjoy financial peace of mind, maximize their life, have a great, peaceful journey while they also have great outcomes. So let's take a look at a couple slides, Alex, and unpack these. And don't be afraid to hit me with a question, Alex, if you're looking through the eyes of one of our great show listeners. But let's go ahead and dive in. One of the first slides that we wanted to share with you and some information here is when you look at the history of bull markets versus bear markets. So times the market's going up, times the market is going down. The bear is in the orange color. And as you can see, they're very short in nature. In fact, the average bear market is 11 months and the cumulative loss is 31%. That sounds really terrible, right? 11 months, you're down 30%. But when you look at the average bull market in blue of 4.3 years with a cumulative return of 150%, I would ask this question. Are you willing to deal with 31% temporarily over 11 months so that you can enjoy 150% cumulative gain over 4+ years? I think that answer has to be yes.
Well, and also, if you're an engineer listener, for example, and you're trying to find a pattern here or something, or some sort of cyclical way you can prevent or you can predict this going forward. I mean, I don't see one. I mean, it's not possible to predict the next cycle or pattern, right?
It's so difficult. They come at different times for a multitude of different reasons.
If at any point in time, you guys, if you want to reach out to us, you can subscribe, of course. You can also just email jason@financialdetox.com. We love meeting new people and kind of walking you through this on a more private individual basis, like why you shouldn't jump ship into cash and why it makes sense for you and what you should do about your portfolio, which is we're going to get to here in a minute here as well.
But it's a really good point, Alex. We are high level overview on these shows. And that's the point, is to give you a little bit of information, let you know what's going on out there. And then we got to unpack this for you personally and individually because everybody's situation is unique. But look, when you look at the history of bull and bear markets, it's really important to be invested. But you've got to be invested the right way. So let's talk about a little bit more on just time. If you look at the history of positive markets versus negative, and a point you alluded to before the show, Alex, this is one particular part of the market. This is the S&P 500 index. This is not the whole market. The S&P 500 is 500 stocks, generally very large cap, very much growth oriented, especially lately. So this is not even a very good proxy for a well-diversified portfolio. It's just a sampling that has the longest history of data that we can use and that often gets used. But we're not suggesting you invest in the S&P 500. We're not suggesting this is a good portfolio. In fact, we're actually suggesting the opposite. It should be a part of your portfolio, but it should only be a part of it. But when you look historically at that S&P 500, here you have 74% of the time on 1 year periods, you make money in the market. And the average up year is 21.5% during those positive years. The negative years are 21% of the time, with an average negative of 13.4. Question is, if we could go to Vegas today and we could play blackjack or craps and be given a 74% chance of winning money, I think Vegas would quadruple in size overnight because we could go make money and it would be fun.
Actually, they'd probably go out of business if we were taking all of Vegas's money.
True.
It'd be over.
They would, right? So how would you like to be the house? And when you invest in a well-diversified portfolio, I think you could even have better outcomes than we're presenting on this screen, but you can have better odds than Vegas casinos have in that sense, because you could have a 74% chance of making money every year if you don't have behavioral blunders. So
hold on. I've got a client in my
head.
I'm not going to say the person's name, but I call them a critical person where everything's always too good to be true.
Sure.
And just going one level deeper on this, Jason, I think is super important. Why is that the case, right? Because if it weren't the case, if capitalism didn't win most of the time, it would cease to exist, right? You've taught me this over the years as well.
It's true, Alex. We are investors, right? And our clients are investors. And we as investors demand a rate of return for our capital. So if we put our capital into equities, we expect, for the amount of volatility and risk associated with that investment, we expect a certain rate of return. If that diminished over time, we would change and seek other opportunities as a whole, investors and capital. Same with bonds. We expect a lower amount of risk and volatility with bonds. And for that, we expect a lower rate of return. So yes, this is why returns happen. And the market is also like a funnel. I like to think of it like literally just a classic funnel where new innovation, new technology, new stocks are going into the top of the funnel, and out the bottom, which is much smaller than the opening at the top, is the junk, right? The garbage, the failed companies, they're falling out. So new innovation continues to drive us forward. So there's always new companies that are growing, that are entering the marketplace, whether public or private. And that is why we can continue to expect, I think, these types of returns. Will it be exactly the same? I can say certainly no. It won't be exactly the same as in the past. But should we use this as some kind of indication of what we can expect going forward? And I think that answers yes.
All right, next one.
Let's go forward. All right. So as we look at what should you do, though, before the end of the year, we do think you should take action, and we do think you should be nervous. Right now, the S&P 500 is largely concentrated into the top 10 stocks. That's dangerous and potentially scary. It's really important to start thinking more sophisticated. Think like an endowment. Think like a family office. That is a very large organization or family that has tons of money and hires their own suite of advisors. Pensions, sovereign wealth funds, high net worth individual investors, and even financial professionals, and even down to retail investors. When you look at these, they have a much higher allocation to alternative investments. Endowments have 40 to 60% of their money in private or alternative investments. Family offices, 30 to 45%, so on and so forth. So why do they allocate their money differently than the retail investor, which is not even on this chart, really, if you think about retail investors and or even financial professionals? Massive differences in how they allocate their money. Well, let's look at why. There's a lot on here, including important disclosures. But if you look at the main sections where my cursor's moving, and I think you can see my cursor, you may not be able to, but top left quadrant, average annual return. And you can see a 60-40 portfolio. That is 60% stocks, 40% bonds. That portfolio, average annual return over the time period shown, 8.5% return. But if you had 15% alternatives, private investments, private equity, private debt, infrastructure, real estate, you're able to garner an extra bit, a little bit more return. If you add 25% alts, even more alts, you garner even more return. But the kicker here is when you go across to the top right quadrant, you see that by adding those alternatives, the 15% in the orange and the 25% in the gray, you also are lowering your overall volatility or risk as measured by a standard deviation. The bottom two quadrants tell you the same story, risk return ratio, and also your drawdown is a big 1 year downside potential. So by adding these alternatives, like these groups of people, endowments, family offices, pensions, and sovereign wealths, and high net worth individuals, you end up getting better risk adjusted returns. Here's another look at the same data. This is an efficient frontier showing you how do you create the highest, top left would be the highest return with the lowest risk. And so in the top left, how do you move your portfolio up towards that area of this graph? And you do that by adding in the alternative allocations, getting less volatility and more potential return. Pretty special way to, almost like a free lunch. You can know that if you do this in the right way, there's a high probability of good outcomes. Last but not least, I want to show a couple specific endowments. This is publicly available information, hence we were able to show it via the source down below. Harvard and Yale, compared to a perfectly invested 60-40 portfolio, stocks and bonds, no behavioral blunders, the returns are demonstrably different. You can see that Yale had 10.49, while Harvard had 8.8, and a 60-40 portfolio had 6.42% returns. This compounded over a bunch of years is going to have a massive impact on you and your financial picture. So what our story is, as you look to the end of the year and you think about this very good question, is the markets are at all-time highs and they've been at highs for a while. This has been a unbelievable bull market. I've been investing and helping clients save and prepare for their wealth for over 27 years. Save their wealth and prepare for retirement and their financial futures. And this is one of the most extended, I almost say egregious, but it's a great time to ask the question, am I invested correctly? Do I have an intelligently constructed portfolio? Am I investing like an endowment, an institution? Am I doing the best I can do for myself? When we talk to prospective clients, at least 9 out of 10 times, their portfolios are not optimized. They're not optimized from a endowment, private or alternative investment standpoint. They're not optimized from a tax planning and tax optimization standpoint where they're harvesting losses throughout the year. So there are some things you can do and you should be taking action at the end of the year, right? Alex, anything you would add into that?
I would just invite the conversation, because if you're thinking, should I be scared right now because you don't know what's to come, then you probably should be. And you probably should get a second opinion. Even if you have an advisor, it's always good to follow your instincts and trust those just to get a second opinion.
Exactly. And we'd love you to subscribe, click the links below, get engaged with us. This is an open invitation to have a no obligation. There's no cost. There's no voodoo magic in the background where we're trying to sell you something. This is about relationships at IDA Wealth, the business to financial detox. We help people avoid the great behavioral blunders that most investors make. We help you create true financial peace of mind and manage your wealth for maximum impact. So get engaged, connect with us, or just check out some more shows and see what you think. Thanks so much for tuning in. As always, we wish you happy investing, invest well, and live fully. Thanks. I'm Jason.